Hello, Clive Tompkins reporting for the Finance News Network. Joining me from the Antares High Growth Shares Fund is Senior Investment Manager Richard Dixon. Richard, welcome back.
Thanks for having me back.
First up, can you explain how you manage the fund?
Well, the High Growth Shares Fund is an Australian long-short shares fund. It aims to significantly outperform the ASX 200 accumulation index over the longer term. Now, in doing that, we employ three key strategies to try and broaden the opportunity set of the fund. So firstly, there's short selling, there's enhanced long positions or larger overweights with the funds from the shorts, and also active trading, so really to try and take advantage of opportunistic opportunities in the market.
Thanks. So how did the fund perform over the September quarter?
The fund had a solid performance again during the quarter, managed a small positive return of a net return of 0.1%, and that was versus a broader market that fell during the period, which was down around 0.6%. And really the broader market weakness was driven by the banking sector in particular. There was increased regulatory capital concerns around the market, plus the other big part of the market being the resources, which were weighed down by a significant decline in both the iron ore price and the oil price, which both fell more than 15% during the period. And
Richard, which stocks added to performance and which ones detracted?
Well, our large overweight position in Amcor was the biggest contributor. Now the stock rallied around 10% in the period, and the market was very pleased with their full year result, which included a higher than expected dividend, and also the company outlaid some pretty healthy organic growth opportunities that the company has going forward. Another positive contributor was a decline in the share price of ALQ, so an underweight position that we held there. And they basically warned that their profits were going to be down around 35% on the PCP, so the stock fell very heavily during the quarter, which boosted our performance. Second, in terms of negative contributors, there were two stocks that were quite small in terms of contribution, but they did weigh a little bit on the fund. So that was Trans-Pacific Industries and also Crown, and they were really weighed down by firstly Trans-Pacific, a fleet recall and a soft result that they delivered, and secondly Crown, which really was weighed down by weakness in Macau gaming revenue.
And Richard, what changes have you made to the portfolio since we spoke at the end of June?
We added Westfield into the portfolio when it was trading under $7.30. We viewed that as an attractive entry point. We really liked their US dollar earnings, their offshore exposure, and really the focus on global mega flagship shopping malls. It's really their key focus going forward now post the demerger of the domestically focused Centre Group earlier this year. Secondly, we increased our position in Aristocrat, which was stock held for a while, but we participated in the equity raising that they undertook at $5.26 early in the quarter, and the stock really that was to fund their acquisition of VGT Systems in the US, which is highly accretive to earnings for Aristocrat, and the stock has reacted positive to that. It's been re-rated up towards $6 and actually continued up towards about $6.50 into October, so that's been a good performer. We reduced our position in Woodside and actually moved underweight the stock at around $42, and really just a bit of concern around the production growth outlook in the next few years, and particularly in light of the weakness that we've seen in the oil price, which, as I mentioned previously, fell quite sharply during the period.
Last time you were here, Richard, you had just increased your stake in Echo Entertainment Group. How's the stock been performing?
Yeah, Echo's continued to track along pretty well. I think it rallied about 6% again during the quarter in a weak market. So the market really quite likes their defensive earnings profile, and we've seen quite a turn in their earnings both in New South Wales and their Queensland businesses, and really in a market that's lacking top line and revenue growth across the broader share market. It's really quite appealing for a number of fronts. So that stock's continued to perform well and has risen again into this quarter through October. So yeah, still going to stick with that position, and yeah, pleased with how that's tracking along.
And Richard, reporting season is behind us again. Were there any major surprises or themes to emerge?
Generally, the reporting season was a bit ahead of expectations. I think it was around 35% of the ASX 200 beat expectations, whereas about 24% missed those expectations. A lot of those have been lowered coming in, so it sets the bar a bit lower, but generally it was a bit ahead. We saw some quite consistent themes come out that we've seen in the last few reporting seasons. So again, top line or revenue growth seeming quite hard to come by for many companies, and really looking to cost cutting to sort of get the growth, and that was very evident across the market. Plus capital management and either increased dividends or buybacks or special dividends, which we saw from a few companies such as Telstra and Wesfarmers, and really that's in a market that's desperate for yield and income. So a lot of companies are skewing their or increasing payout ratios and dividends as they can. In terms of individual stocks, there was a few that beat expectations, and some of the offshore exposed companies such as Amcor, which I mentioned previously, CSL also delivered ahead of expectations. Suncorp had a strong result as well, and again they saw higher dividends. On the negative side, there was a few that disappointed. In particular, James Hardie seemed to have some operational issues and I guess a weaker than expected recovery or stalling in the recovery of the US housing market. We also saw Navitas disappoint quite significantly, and JB Hi-Fi also had a soft result as some of their iPad sales in particular were very sluggish into the period. So they were the key themes and surprises.
Richard Dixon, thanks for the update.
Thanks for having me in.